Stop everything you're doing right now. Yes, that includes checking your brokerage app for the 10th time this hour, watching a number that means absolutely nothing, because right now, every single warning sign from 3 historical delivery failures is present in the silver market simultaneously. And if you're holding paper silver, you need to understand what those 2 words mean. Force majeure, superior force. The legal mechanism that allows an exchange to admit it cannot deliver the metal it promised, force cash settlement at paper prices, and transfer wealth from paper holders to physical holders completely legally. It happened in March 2022 with London Metal Exchange nickel. Trading halted for 8 days. All positions forcibly closed at prices chosen by the exchange to prevent total system collapse. It happened in January 1980 with COMEX silver during the Hunt brothers squeeze. Rules changed retroactively. Position limits imposed mid-crisis. Longs liquidated at suppressed prices. It happened in March 2020 with COMEX silver during COVID. Refineries shut, transport froze, delivery delays stretched to 6 weeks. The exchange couldn't fulfill contracts on time. Every historical force majeure event has a signature pattern. 5 specific conditions that appear before the exchange admits failure. For the first time in recorded commodities history, all 5 conditions are present in silver right now, simultaneously. Let me show you why this isn't speculation. This is documented pattern recognition from verifiable market data. Right now, COMEX silver futures quote $71.50 per ounce. That's the price on your screen, the price CNBC shows, the price printed on derivative contracts. But if you want to buy physical silver you can actually hold, the real price is completely different. According to market reports published January 2nd by Financial Content analyzing physical dealer pricing, Tokyo dealers sold silver at $130 per ounce in the first trading sessions of 2026. Dubai dealers, $127. Kuwait, $106. Seoul, $97. Even Walmart in the United States is pricing 1-ounce APMEX bars at $87 according to the Silver Industry Analysis, an 80% gap between paper futures and physical delivery prices. That gap has a name in commodity market analysis, pre-force majeure divergence. It's what happens in the weeks before an exchange admits it cannot deliver. The paper price becomes a reference number disconnected from physical acquisition costs. The physical price reveals what it actually takes to secure deliverable metal. And on January 1st, 2026, the trigger event occurred that makes this divergence permanent rather than temporary. China implemented immediate export restrictions on silver that CNBC reported December 31st as the most aggressive precious metals controls in modern history. Effective midnight Beijing time, January 1st, only 44 state-approved companies with government licenses can export silver from China. Every single shipment requires explicit authorization from the Ministry of Commerce. China controls 60 to 70% of global refined silver supply. According to industry analysis published by FX Street and AI Invest, they refined approximately 40% of all silver mined globally in 2024. With one policy change at midnight, they cut Western access to the majority of available refined silver. Tesla CEO Elon Musk responded on his X platform, "This is not good. Silver is needed in many industrial processes." He's correct, but the implications go far beyond industrial inconvenience because China didn't just restrict their exports, they created the mechanical conditions for Western exchanges to face delivery failure. Let me show you the 5 conditions that precede force majeure and why all 5 are now present. Condition 1. Physical supply disruption. China's January 1st export licensing requirements severed Western access to 65% of global refined silver supply, verified by CNBC and South China Morning Post reporting. Condition 2. Registered inventory depletion. COMEX registered inventory, the silver actually available for delivery against futures contracts, collapsed 70% from 2020 levels according to analysis by Crux Investor using CME Group data. From 346 million ounces in 2020 down to 82 million ounces by late 2023, with continued drawdowns throughout 2024 and 2025 confirmed by SchiffGold's December analysis of CME warehouse reports. Condition 3, delivery demand surge. On January 7, 2026, holders of 1,624 COMEX contracts representing 5,000 ounces each took physical delivery of 8.1 million ounces according to CME delivery data analyzed by David Jensen. JP Morgan Securities delivered 99% of that metal from their allocated vaults. That's not normal January behavior. January is historically a minor delivery month. This represents institutional positioning ahead of anticipated supply stress. Condition 4, failed arbitrage. The mechanism that's supposed to close price gaps automatically, arbitrage, has broken down. Arbitrage requires buying cheap in New York at $71, shipping physical metal to Tokyo, and selling at $130. But secure transport companies that move precious metals are operating at capacity with extended lead times, according to industry reports, and air cargo space for insured bullion shipments faces similar constraints. The physical metal cannot move from west to east fast enough to close the gap. When arbitrage fails due to logistics rather than economics, price divergence becomes structural rather than temporary. Condition 5. Exchange crisis measures. The CME Group raised initial margin requirements for March 2026 silver futures contracts from $20,000 to $25,000, a 25% increase according to BN Crypto reporting published in late December. This forces leveraged traders to post additional capital or face automatic liquidation. When exchanges raise margins aggressively during holiday periods when most participants are offline, that's not routine risk management, that's crisis containment. They're attempting to reduce delivery pressure by forcing position liquidation before the system reaches breaking point. All 5 conditions, present simultaneously, verified by public data from CME Group, documented by financial press, confirmed across multiple independent analyses. This has never happened before. The 1980 Hunt Brothers squeeze had 3 of 5 conditions. The 2020 COVID disruption had 2 of 5. The 2022 LME nickel crisis had 4 of 5. No historical event had all 5 signatures present at once, until now. Let me show you what force majeure actually means in mechanical terms. When an exchange invokes force majeure, they're making a legal declaration under contract law. They're stating that extraordinary circumstances beyond their control, superior force, prevent them from fulfilling delivery obligations. Once that declaration is made, all outstanding contracts get cash settled at a price determined by the exchange, typically the last traded paper price before the declaration. If that settlement price is $71 per ounce and physical metal on the street is trading at $130, the difference doesn't get paid to contract holders. The difference is the wealth transfer, from those who held paper claims to those who held physical metal. Section 8 of the SLV prospectus, the largest silver ETF, explicitly states, in extraordinary circumstances, the trust may settle in cash rather than deliver metal. Extraordinary circumstances is legal terminology for force majeure conditions. If you own SLV shares, you don't own silver. You own shares in a trust that holds claims on silver stored in COMEX allocated vaults or priced against COMEX reference prices. When COMEX invokes force majeure and cash settles at $71, SLV follows that settlement. You receive $71 per share equivalent. The metal you thought you owned never materializes. And the physical silver trading at $130 on parallel markets, you have no access to it at any price because it's no longer available for purchase. Let me show you the wealth transfer in concrete terms. 2 investors, December 2025, both allocating $100,000 to silver. Investor A buys SLV, convenient, liquid, trades like a stock, holds paper claims on COMEX allocated silver. Investor B buys physical bars through a dealer offering allocated segregated storage. Less convenient, takes 3 days to settle, but the metal has serial numbers, sits in a vault with his name on it, is fully insured, and comes with audit rights. COMEX faces delivery requests it cannot fulfill. China's export restrictions mean there's nowhere to source replacement inventory. Registered inventory is depleted. Transport logistics are gridlocked. The exchange has binary choice. Admit total failure or invoke force majeure. They invoke force majeure. All outstanding futures contracts cash settled at $71 per ounce. SLV, holding COMEX allocated metal or pricing against COMEX reference, follows the exchange ruling per Section 8 of their prospectus. Investor A gets $71,000 for his $100,000 position, a 29% realized loss. Investor B holds physical metal in allocated storage. The exchange's declaration doesn't affect his bars. They're not COMEX inventory. They're not part of the futures delivery system. They sit in a vault with his name outside the exchange mechanism. Those bars are now trading on physical markets at $130 per ounce according to verified January 2026 dealer pricing. His $100,000 position is now worth $182,000. Same starting capital, same December 2025 entry point. One person lost $29,000. One person gained $82,000. The difference? Understanding that owning a claim on metal is not the same as owning metal. Force majeure is the mechanism that executes that transfer legally, documented in contract terms, irreversible once declared. Now let me show you why the timeline matters. Wall Street operates on a skeleton crew from December 20th through January 5th. Major institutional money managers, hedge fund decision makers, bank trading desk leadership, they're offline. Junior staff runs overnight risk monitoring. No major position changes. Markets on autopilot. January 1st happened during that window. China's export licensing took effect. Physical markets diverged from paper by 80%. Delivery requests spiked. All of it occurred while the people who make institutional decisions were on holiday. Monday, January 12th, they return, they open their risk management systems, they see the data from January 1st through 7th, and they face a decision tree with limited options. Option 1, deliver physical metal to satisfy contracts, but registered inventory is down 70%. China blocked new supply January 1st. Transport logistics are constrained. This option requires metal that doesn't exist in accessible form. Option 2, raise margin requirements to force position liquidation and reduce delivery pressure. Already implemented. 25% margin hike. But if that doesn't work, if contract holders refuse to sell and instead stand for delivery, this only delays the timeline. Option 3, invoke force majeure. Admit the exchange cannot fulfill physical delivery obligations. Cash settle all outstanding contracts at the paper price. Protect the exchange infrastructure. Let physical metal trade wherever it wants on parallel markets. Transfer the loss to contract holders per the terms they agreed to in Section 8 of the prospectus. Historically, when Option 1 is physically impossible and Option 2 proves insufficient, Option 3 becomes the only viable path. The margin hikes of late December represent Option 2 in progress. The question is whether those margin increases successfully reduce delivery pressure. If delivery requests continue at record pace despite margin hikes, that's the signal that Option 2 has failed, which leaves only Option 3. Based on CME delivery data from January 7th showing record demand despite the margin increases, Option 2 is not working. 8.1 million ounces delivered in a single day in a minor delivery month indicates participants are prioritizing physical acquisition over everything else. They're paying the higher margins, they're demanding metal anyway, that means the exchange is running out of time before Option 3 becomes necessary. Let me show you why this matters beyond individual positions. The Federal Reserve has tools to manage dollar liquidity, derivative exposure, and financial system stress, but those tools have hard physical limits. The Fed can inject unlimited dollar liquidity. They can backstop derivative positions. They can provide emergency funding to primary dealers. What they cannot do is create physical silver that doesn't exist. They cannot print atoms. They cannot reverse China's export restrictions. They cannot make transport logistics move faster than physics allows. When financial engineering hits physical limits, force majeure becomes the release valve. The exchange admits the paper system cannot deliver the physical goods. The paper market effectively ceases to function as a price discovery mechanism for actual metal, and holders of paper claims discover what Section 8 of the prospectus means in practice. Now let me show you the structural reason why industrial demand makes force majeure more likely in 2026 than in previous squeezes. In 1980, the Hunt brothers squeeze was speculative. Wealthy individuals accumulating silver to corner the market. When COMEX changed rules and forced liquidation, the Hunts were speculators who could be forced out through margin pressure and position limits. The physical demand was artificial. In 2020, COVID disrupted transport and refining temporarily, but industrial users could delay production, draw down existing inventory, wait for logistics to normalize. The demand was elastic. In 2026, industrial silver demand is structurally inelastic. These aren't speculators chasing price appreciation. These are manufacturers who need silver to build products that cannot be manufactured without it. Solar panel production requires silver paste for photovoltaic conductivity, with no viable substitute at current efficiency levels. Electric vehicle battery technologies under development use silver composites in next-generation designs. AI data centers require silver thermal interfaces for high-density computing. Defense systems use silver in guidance electronics, radar, and communications where reliability is non-negotiable. According to FX Street analysis published December 28th, industrial demand from AI hardware and renewable energy infrastructure consumed approximately 60% of total global production in 2025. That demand cannot be postponed. Production lines don't pause. Defense procurement doesn't stop. Technology development doesn't wait for price normalization. When demand is inelastic and supply is severed by China's January 1st export restrictions, price discovery becomes binary. Either you deliver the physical metal at whatever price it takes to source it, or you admit you cannot deliver and invoke force majeure. There is no middle ground where industrial users accept partial delivery or delayed shipment. They need the metal now to maintain production schedules. COMEX is discovering this binary choice in real time. The South China Morning Post reported December 31st that under China's new licensing regime, exporters must prove they executed silver exports annually from 2022 through 2024, and new applicants must demonstrate annual production exceeding 80 metric tons with consistent export records. This eliminates hundreds of smaller and mid-sized exporters who previously supplied Western markets. Only 44 companies received approval for the 2026 through 2027 period. That's not a temporary trade restriction. That's permanent restructuring of global silver supply chains with China as the explicit gatekeeper. Western exchanges now face delivering metal in a world where 65% of supply requires Chinese government approval, transport logistics operate at capacity, and industrial demand is non-negotiable. That combination has never existed before. Let me show you what happens after force majeure is declared based on historical precedent. Immediate chaos for 24 to 48 hours. Paper markets experience extreme volatility or trading halts, while the exchange implements cash settlement procedures. Physical markets continue operating, but with severely limited liquidity, as holders refuse to sell at any price below massive premiums, knowing the metal is irreplaceable. Then comes permanent market bifurcation. Two distinct markets operating on completely different principles. The paper market, if it continues to trade, becomes a purely financial derivative with no connection to physical delivery. It's a bet on the price of silver, not actual ownership. The physical market trades separately with pricing based on actual supply and demand for deliverable metal where participants can take possession. The gap between the two doesn't close. It becomes the new market structure. One market for financial exposure, one market for physical assets. They never converge again because the mechanism that's supposed to link them, arbitrage via physical delivery, has been permanently severed by China's export controls and logistics constraints. If you're holding paper when force majeure hits, you're locked into cash settlement at the paper reference price. No option to convert to physical. No access to the physical market at any price. The metal you thought you owned never materializes. If you're holding physical metal in allocated storage when force majeure hits, your metal didn't disappear. The exchange's failure doesn't affect your bars sitting in a vault with your name on them. You own an asset that's trading at premiums of 50 to 100% above the paper settlement price, and you control when and whether to sell. Force majeure executes the wealth transfer from paper to physical, mechanically, legally, irreversibly. This isn't conspiracy theory or fear-mongering. This is pattern recognition from documented historical events applied to current verified market data. Condition 1 verified, China export restrictions effective January 1st per CNBC reporting. Condition 2 verified, COMEX registered inventory down 70% per CME data analyzed by Crux Investor. Condition 3 verified. Record delivery demand January 7th per CME warehouse reports analyzed by David Jensen. Condition 4 verified. 80% physical paper price gap per financial content market analysis. January 2nd. Condition 5 verified. Emergency margin hikes per B and crypto reporting December 2025. All 5 historical warning signs present simultaneously. Documented by verifiable sources. Confirmed by public market data. The next 5 to 10 trading days are critical. If delivery pressure continues despite margin increases, if physical paper gaps widen further, if registered inventory continues draining at current rates, those are confirmation signals that the system is approaching breaking point. Force majeure doesn't announce itself in advance. There's no countdown timer. You wake up one morning, open your brokerage account, and see a notice. Due to extraordinary market conditions and inability to source physical metal for delivery, all positions have been cash settled at the previous closing price pursuant to force majeure provisions in your contract. Past tense, already executed, irreversible. The question you must answer immediately is simple and binary. Do you own physical metal in allocated storage that cannot be cash settled away from you? Or do you own paper claims that are subject to force majeure provisions in Section 8 of the prospectus? That's not rhetorical. That's the difference between wealth preservation and wealth confiscation when the exchange admits it cannot deliver. I didn't create this video to generate fear or sell products. I created it because every documented warning sign from 3 historical force majeure events is present right now in verifiable market data, and almost nobody is connecting the patterns to the precedents. COMEX registered inventory is depleted. China severed Western supply access January 1st. Delivery demand spiked to record levels despite emergency margin hikes. Physical paper price gaps reached 80%. Transport logistics cannot close arbitrage gaps. Industrial demand is structurally inelastic. Force majeure is no longer a tail risk scenario. Based on historical pattern recognition and current documented conditions, it's the probable resolution mechanism within the current quarter. The system will not provide advance warning. CNBC will not run a countdown to force majeure declaration. You will wake up one morning and the cash settlement will already be completed. Past tense, irreversible. 5 historical warning signs, all present simultaneously. Verified by public data, confirmed by independent analysis across multiple sources. The question is whether you're holding atoms or holding promises when the exchange admits it cannot convert one to the other. And if you think silver is the only market showing force majeure signatures, you need to understand what's building in gold right now. Central banks purchased over 1,000 metric tons of gold in 2025, according to preliminary World Gold Council data, among the highest annual accumulations in modern history. They're not buying because they expect 10% price appreciation. They're buying because they see the same paper physical divergence risk across all precious metals. They're positioning for a world where paper markets separate from physical delivery markets permanently. The analysis of why central banks are accumulating physical gold at record pace, what that signals about force majeure risk across the entire precious metals complex, and why gold may follow silver's pattern within weeks if COMEX declares delivery failure. That's in the next video. Click it now. Because the warning signs in gold are building the same way they built in silver throughout December. The pattern is identical, the timeline is compressed, and the implications affect every holder of precious metals exposure regardless of whether it's physical or paper.